Good morning, James.
Good morning, James. Good morning, everyone.
Thank you very much. I've got some slides that you kindly gave us, and so I'm going to let you run through them. So they're based on the results from the end of June, but they
Yeah,
should give you an indication of how the fund works. So over to you, James.
great. Thank you, James. Yes. So I'll talk for about 20 minutes about Bluefield Solar. So this was a business that we IPO'd in 2013 and is focused on the UK solar market with some exposure to wind and batteries, which I'll talk about. But it's been a very high performing fund over the past 11 years, and it's an interesting time to have a think about it because, like every other infrastructure, not just renewables, but infrastructure investment company at the moment, we're at a discount. We're about a 15 or so, 16% discount to our net asset value, and yet the fundamentals of the business about delivering alternative, attractive, stable, defensive income are there, and we've proven that year in, year out. And so it's and we've just given the results, as James said, for the period ending June, which were another very strong set of results, which I'll touch on. But it's a very sort of interesting model, and particularly there's some very strong tailwinds for the sector, both politically and also just we've got a view on power as well, which is we'll talk about at the end. So if we go on to the next slide, if that's okay, James. So just to set the scene, what you've got is an asset base of about 1.4 billion. NAV is about 800 million. Market cap at the moment of the share price is going to be about 650 or something. But you've got a very diversified, high quality portfolio. Overwhelmingly, it's solar assets. We've actually got about 900 megawatts now because we've just grid connected a brand spanking new 50 meg site in Northamptonshire, which has got contracts for difference attached to it. But what you've got very high levels of regulated revenues, and also we can also sell the power, and it's been a very very successful strategy in terms of generating stable defensive income. Just as a very quick observation about the renewables industry, not all renewables are created equal, and if you want the most stable, the simplest, the most defensive and most predictable, go for solar. And that applies for the UK as much as it does anywhere else in the world, because your power source comes on in the morning and goes off at night, and we can model the generation profile within a bound of an average number within about 3 or 4% every year. So it's an incredibly stable way of generating alternative income. Yes, if you hop over to the next slide, please, James. So again, sort of emphasizing the simplicity of the model, the predictability is that we generate the vast majority of our megawatt hours. On the top left there is from solar, and then we've got some what they call the slightly smaller single stick turbine wind assets on the right, and then that flows in, and you've got the generation side. So if you look on the left hand side there, you've got very high levels of dividend cover. So we are the second highest payer on a pence per share basis in the infrastructure space. We've lost the crown being the top payer by UK wind, but maybe we'll get it back one day. But you've got very high levels of dividend cover. You see it on the left, it's 1.8 times, which is this year, and we're expecting that to actually go up fairly materially next year. And then if you drop down through the middle, we like to amortize debt. We've got a defensive capital structure, but post that, so net, as we say, you've got a dividend cover of 1.4 times, which again is expected to rise to closer to 2 times next year going out. And the simple reason for that is that this year actually irradiation was a little bit low, which we expected to obviously to trend back to its normal average. And also there were a couple of performance issues which were very sort of isolated, that have been dealt with within the portfolio. And so we are expecting obviously to see that move back up to get to that, as I say, close to sort of 2 times net dividend cover for the fund. Because the next page, please. Oh, yes. So these are the highlights, as I mentioned, about 1.4 billion of gross assets. So very high quality sort of revenue streams. The NAV has dropped a little bit in the last 12 months, but that's a function partly because the market's shut, and we'll talk about how we've dealt with that in a moment. But so there's been no capital raising, so you do tend to get a little bit of an unwind of the unwind of the discount. So you've got a sort of a little bit of loss there, but also the power markets have come down a bit, which we'll talk about. So that you can see it's still pretty stable, and it's still one of the highest NAVs in the sector. Very high levels of operational cash flow, so that's driving that dividend cover that I've just mentioned. Again, a little bit lower than last year, but last year we had our record numbers in every single measurement we had. So it was it's still a very good performance. Gearing, again, defensive. This is about getting income dividends in a quarterly basis back to our shareholders. So the gearing is prudent, and we're actually looking to lower that at the moment with paying down some of the revolving credit facility that we've got. Average cost of debt, so this is just the fixed debt. We've had a good debt crisis, as they say, because all our debt was fixed and amortizing, and so it's just shy of 3.5%. So that hasn't budged in the last 3 years. So that's all good, and it's also long duration. We like to amortize and pay down because we've got lots and lots of regulated revenue. So it's a good use of debt. And then the bottom line, we mentioned the dividend cover, so which is obviously healthy. I think the interesting thing is this dividend covered dividend target, which, as I say, is 8.9, or not less than, I should say, to be precise and quoting the chair, not less than 8.9 for the period ending June 25, which is good, and obviously gives this very, very attractive dividend yield of 8.3%, so up from what was even quite attractive last year at 7.3. But when you consider it's a low risk asset base, UK focus, very high visibility of revenue streams, it doesn't have that sort of the variability that you have in lots of different investments. It feels like a very attractive dividend. On the next page, please, James. So this goes to sort of emphasize this point about being one of the highest payers of dividends, and this is from the first year, just 2013, 2014, was we weren't a full financial year, so there wasn't, and so really looking from 14 onwards is where you've got this high level of both covered dividends, which are growing and have been delivered to shareholders very consistently. And then if you look at the top side there, overall it's been, let's say, the highest performing fund of its kind in the listed space, very consistently over a decade. So very high total return and matched to this attractive dividend. So it works very well, as I say, for alternative income, but now with the added kicker that you've got what is a pretty sizable discount to what is certainly in different markets, certainly private markets, is going to be viewed as a very sensible NAV that we have in place. So maybe just another quick observation about that predictability of the revenue stream. So we've been very successful in our power sales strategy. So with a fund like this, you have a mixture of regulated revenues, and you also were able to sell our electricity into the wholesale market. And if you take the bar charts on the middle of this page, the way this looks, if you take it out to the 2034, that would be the 21st anniversary of the company. And if you take it from the left, the dark blue, the regulated revenue. So those are primarily they are RPI linked revenue streams, so very attractive. Some of the CFDs we're bringing on are CPI. You've then got the green element is merchant, and then you've got this light blue, which is the PPAs. And what we've designed, which has materially outperformed the market and also the spot market, is that we like to fix in the short end of the power curve. So that's 6 to 30 months. Now, why we do that is because it's the most liquid part of the market. It's also where you can get the highest prices. But we've designed the capital structure enables us to do that. And so what you'll see is that at any one point in time, as in today, you've got almost complete visibility of what your revenues are going to be. And then as those PPAs will drop off, those fixes, we'll then start replacing them. So if you wanted the kind of the template, it's that 25% of the capacity comes off every 3 months and you're rolling it forward. So if you spoke to me in 12 months' time, this chart would look very similar. It would just have different dates at the bottom because you're restriking the contracts. It's been a very successful strategy for us in terms of how we've outperformed the market. And we'll come back to that just at the end, actually. So I think the big question that has been posed, and James and the team have also been trying to answer, is what do you do in a closed market? So obviously, since really since the mini budget, which is just over, just our second year anniversary of that, is that the market has been shut for new capital raises. So what are the priorities in terms of capital allocation? So we spent a lot of time last year. We had this fantastic set of results, and we went out rather sort of cock a hoop talking to the market, and we were met with rather glum faces of fund managers who were really struggling because obviously they'd seen very, very big discounts across the board, particularly obviously renewables and infrastructure. And so having consulted extensively with the shareholders, what we concluded was that it's about a time for being very cautious, and for us trying to protect both the long-term interests of the business, but also how do we create some liquidity in the short term. So the way that we've addressed that is, and one of the unique features about Bluefield Solar is that we've got a very large development pipeline, which is about 1.5 gigawatts of primarily, well, it's a mixture of solar and batteries. And there's been an announcement about batteries in the last 24 hours, which I will update people on. But what we were basically asked to do is say, well, how do you manage that sort of short-term liquidity where we wanted to try and pay down the revolving credit facility to just lower that sort of burden down, but also protect the long-term interests of the company, which is by being able to push forward the development pipeline. So you've got two almost quite sort of contrasting challenges. And the way that we've addressed it was through a strategic partnership with a group called GLIL. GLIL is a direct investing arm of one of the pools. It's called LPP, which is Local Pension Partnership, and then it's got West Manchester. So it's the LGPS, if you know those sort of the big local authority pension schemes. And so we've done entered into a strategic partnership with them where they have acquired some of the existing assets, 50% of some assets that Bluefield Solar owned 100%. So we've gone into a separate vehicle that's created cash, which in turn has enabled us to start to pay down the RCF, which is great. And we've also gone into a third stage of that partnership with GLIL, which is about developing part of the development pipeline. So an immediate, sort of ready to build assets where we need to put some cash in to move those forward. So it's been a really good relationship that we built up. I think it's been very good for our shareholders because it's doing those twin points of creating liquidity, but also making sure we can protect the future as well. And in addition, we have started a share buyback program, which is a typical response from boards at the moment. I think the reason we're doing it, I have to say, just to be clear, and I can speak to the board here, is not because we think it's going to shift the price, because there's no evidence for that, I have to say. It's actually about sort of managing liquidity, and so we have every day we've got Deutsche Numis, who are our broker, are in the market, and they're managing those flows to make sure that we've got some good sort of trading of the shares, and also that we're always in there buying, and that's sort of worked pretty well. So that's been a good strategy so far. So I think those are the priorities are the key things in terms of how we've tried to address what is at the moment it remains a fairly sort of firmly closed market. Next page, please, James. A couple of differentiators. I'll just talk in terms of where does Bluefield Solar is it differentiated, and why have we outperformed in an absolute basis and also peer group. So one of those is that we are effectively what's called a sort of an independent power producer, but we externally manage the vehicle. So there are 130 people today working full-time on this vehicle, and it goes from development through to operations, and we do everything in between to protect and enhance value for shareholders. The only activity we don't do is we don't build out assets, because we do that with third-party EPCs. It's a better way of structuring it, but we've got engineering teams, we've got construction management teams, we've got people who are overseeing the build-out. That's been a really key driver in performance, consistent high performance of the portfolio, because we view this as being the custodian of these assets for their life. We don't view it as being a private equity investor where we're going to flog them into, sort of try and make some sort of killing. These are about long-term assets which we can manage. We will buy and sell assets, but we look at it in terms of the management side, that we are going to be looking after them for the life of the assets, and that's the way we've set the business up, and it's worked very well in terms of the performance of the fund. James, on the next page, please. And then it's sort of, that goes to the operational performance that you've seen, and we've got this sort of the cumulative generation on the left-hand side there. It's a function of active management. It's a function of really caring for the assets. It's something which is, we're seeing this in Europe a lot with much older assets that haven't been looked after. Solar is a relatively simple technology, but you still need to make sure you look after the assets. And that's something where we've seen this very consistent performance. And that chart also on the left goes to my opening comments about solar in terms of its predictability. It is something where, yes, we are good at managing them, and we're very actively managing them, but also there is a point about the predictability. And if you look at if you had a comparative chart with something like wind, you would get much higher levels of volatility. And it's not to say wind doesn't work well, and we like it as we've got some of it up in the portfolio, but it does give you much higher volatility around what's called a P50, which is your average expected generation. And just on the right-hand side, just very briefly, very high quality counterparts. Those are the people we're striking those 6 to 30-month contracts with. And you've got people like, Smartest is owned by Marubeni, which is a big Japanese conglomerate, but some very, very good, obviously high quality names. And the next page, please. So this just last few sort of comments and slides is the again, differentiator, really big value driver for Bluefield Solar is our development pipeline, and actually more the DNA of our business is that we have always done construction funding. We've always been very focused on primary assets, so creating new capacity and being able to drive out very accretive returns through that build process. So the first thing is that the construction of solar assets, it's like it once was described, I thought rather memorably, that it's like Meccano for grown-ups. So it's a relatively simple technology. It has few moving parts. We're talking about those fixed arrays typically in fields, and it works. It's something which is a good model to be able to construction fund, because you can get tailor-made assets, brand new to your spec, but also that are going to obviously perform extremely well. And that's been, as I say, been a big driver again in terms of also cost. The price in terms of that you're going in for. In terms of the total build-out cost, and then what the value is once you are operating the assets. There is obviously, you can get a big value driver there. So we've got this lovely portfolio of developments coming through. So the 93, if I just take that sort of the left-hand side for you, you've got that from the top, you've got 93. So those actually, the 93 have just been grid connected actually. So they are now operational sites. There's a 45 meg in just over 40 meg in Lincolnshire and the 50 meg in Northamptonshire, brand spanking new solar assets, which are fantastic. And then sitting behind this is close to 800 megawatts of consented assets. So they're ready to build, and they'll be built out in the next 3 to 4 years. So they will only be built out, obviously, if we've got the cash for this vehicle. But for the shareholders, there's big optionality value, because if selling to the third parties, they're very, very valuable as developments. We spent 5-6 years building up this development pipeline, and you cannot suddenly jump into the market and get grid connections, get planning permissions. The biggest thing is actually getting grid connections, and of this whole pipeline, we have secured grid connections across the whole lot. And then the bottom half is this, where you've got this 690 or so megs in planning. So these are assets which have got grid offers, but they haven't got planning through yet. The way that the current new government is looking at these things is that they are really looking to put their net zero target is 2030. They are much more aggressive about it than the previous government, and it gives us a good sort of sense that we should get those coming through and that they will be successful. In fact, we have at the moment 100% track record in terms of getting planning through. Just to be clear, there is no value in the NAV attributed to that pipeline in terms of the in planning and development pipeline. If we were a utility, you could add on tens of millions because they would chuck it in. But it's just the way that investment companies are valued, and you don't do it. So it's just there's a little bit of sort of what you could argue is sort of hidden value there. And then on the right-hand side is, and this is a really valuable, again, we've got over 400 megawatts within this pipeline of assets which have contracts for difference. So this is the new mechanism that the government wants to support for all new renewables. And you go into an auction and you bid in and you get into a price. You get some, if you're successful, you get a certain price, which is for 15 years CPI linked. And we've got over 400 megawatts of those types of assets attached to the pipeline. And that's, as I say, is incredibly valuable. And what we'd like to do is we'd love to obviously build out some or all of these assets in Bluefield Solar, but equally, if the market's not open, it's again great option value for the shareholders because we can sell them into the third party market, and there's a lot of demand for this sort of stuff. A lot of demand. Okay, and then just sort of finishing up on pricing. Just as we were sort of interested in doing some analysis because the power market. So this drives, if you remember the charts, about sort of roughly the normal market is about 40% of our revenue. So it's a material part. So we thought we'd do a little bit of analysis because it's obviously been an extraordinarily unusual period post. It was kind of slightly post COVID. You can see actually on this chart, if you map that squiggly line, you can see going up to the grey blue box. You can see that actually power markets started rising actually post, it was pre-Ukraine it started to go up. But they went obviously through the roof in February 22 and stayed there through to 23. So to give you a context for people is that we sold a contract in December 22 and we sold it for over £600 per megawatt hour for the winter of 22-23. 12 months before, we struck the same asset. We struck a contract which was circa £50. So you have this rather odd, obviously, very incredible pricing. But what we want to do, and this is just again a really good sense for the listeners about the sustainability of the dividend for someone like Bluefield Solar, is if you look on the left-hand side, the average price. So this is the spot price between 2013 and roughly 2020 was £43 per megawatt hour. Now we materially outperformed that, so we were about our average was about 50. So we did well in terms of striking. So we were not only creating visibility, but we also outperformed that. But the really key thing is that's what people were sort of generating in terms of their wholesale revenues to pay these very attractive dividends. So we had, as I say, during that time, we were the highest dividend payer in the whole of the infrastructure space. If you then go to the right-hand side, you've now got this part of going kind of normalization as much as it can be in terms of the power market. So they've come down, and yet the normalization, if you're taking the forecasts out, is that they're 60% higher than they were in that previous period. So they're saying they're about £70. So if you take the same sort of model in terms of percentage outperformance, we've been nearer to £80, just to give you an idea. That's very, very comforting in terms of where we are with dividends. And I'd say one final thing on this is we never forecast what prices will be because it's a fool's errand. I mean, people don't know what the price of gas will be tomorrow, let alone in 5 years' time. But one thing we do look at is we think about kind of just structural points about whether we think the forecasters are being overly pessimistic, optimistic. And they basically, if you take this chart out on the right hand side, power markets are going to drift down and they're going to get to quite close to pre-COVID levels, which for us seems odd because the world isn't anything like what it is in 2019. The energy markets are not going to go back to normal as long as Putin's in power, and probably way beyond that. So you've got a massive structural difference in the energy markets. That means more expensive imports. Decarbonisation is expensive. You've got deglobalisation. You've got lots of factors which are inflationary. There's one thing also which I think they are underestimating, which is data centres and AI. And it's partly sort of, I suppose, educated by some time I spent in the US, but the US is really clocking the fact that they're going to probably have quite a challenge being able to electrify everything they want to. For example, people like Meta and Amazon have actually taken over nuclear power reactors to be able to get the power that they need. So So what does that all mean? It means, and we've also got in the UK, by the way, near some solar farms that we're developing in Blythe, which was going to be the gigafactory, has been taken over by Blackstone. That's going to be the largest data center in the world, and that alone will have a 1 gigawatt connection. So that's 24/7. You've got to provide 1 gigawatt of electricity. So the point being is, we're not going to say we think it's going to be like £74 or 83 quid or whatever it is. It's just we think that there's a very, very coherent argument to say that it's likely that power will be probably slightly higher than lower, on a probability basis, because of those factors that are coming through, which is all good. But anyway, nevertheless, if you just go with forecasters, it's still a very positive outlook. And then James, on to the next. Yes, so the final slide. So what are we looking to do going forward? I have to say, at the moment, it's much of the same. It was no surprise. If the market's shut, then we should continue doing the good things we were doing before. So the objective is to look to continue to create some liquidity and pay down the RCF. So it's about 134 million now. We've paid down 50. It was at 180. And I think, it's kind of just as a sort of thumb suck. I think getting it below 100 million is a good sort of first next kind of sort of target, I think. So that's something we'll look to do in the next few months if we can. Continue to try and maximize the value of the development pipeline. So we always were going to sell probably about a third of that development pipeline, and we were just going to do it in phases. It's now makes sense to try and do it now because the market's shut and there'll be a lot of demand for it. So there is a plan to sell over 300 meg the development capacity, and that'd be very accretive. Again, not baked into any models at the moment. And then to continue the partnership with GLIL, which has been a great start, as I say, and we think it's strategically very helpful for the shareholders, but also it creates a lovely some very good sort of outcomes for the existing shareholders, particularly in the ability to develop some of the development pipeline. So that's it, James.
That's great. Actually, that's quite a good roundup of where we are, I think. Right, where should we start? I think one thing that I suppose that sort of underpins it all, how real are the government and companies' commitments to net zero, do you think? And do you think that they're going to sort of slip in terms of the timing? Do you think we're actually going to get all the generation stuff we need to get built?
So I think the government is very, very committed to it. We have spent time already. We've been on site on the solar farm we own with Michael Shanks, who is the minister responsible for GB Energy. There was a planned actually trip on Thursday with the Treasury Minister to go to another site. So they're all over it. So in terms of, are they committed? I think they are. What you'll get, which is going to be very helpful for the sector, is consistency. We won't agree with all of their suggestions, but they're going to be consistent. The problem with the previous government was that they were quite bipolar in terms of their view of renewables. Some people loved it, some people hated it, and that's where their policy kind of flip-flopped a bit. So I think in terms of government and public policy, I think they're going to be very, very supportive indeed. They've announced in the last 24 hours a support mechanism, which is yet to be understood, but there's sort of a cap and collar type support mechanism for batteries, which we've been saying they've got to introduce something fairly radical. It sounds like they've been listening, which is good. What will hold this up is, in the centerpiece of this, is how they approach the access to the grid. The big handbrake, James, is grid. And it's not going to be planning. They're going to try and support planning. They're going to push things through. It's whether they can really unlock grid. So I think people need to be, it doesn't affect, I mean, again, it's one of these strategic kind of moats that we've got, because the 1.5 gigawatts, we've already locked down grid capacity, but it's about whether you can then go for another stage in the next 5 years and create more capacity for people. So if they can, it will be amazing for us. And we will be in a great position to be able to maximize the value, I think, for shareholders. But strategically, we're in a good position because we've already spent the last half decade making sure that we're ready for the first wave and grabbing whatever grid capacity we could.
We look at the pipeline. There we go. So this construction stuff you say is done. That's great. GIL are going to help you with some of the other consensus stuff. Is that true?
Yes, it's only a small amount actually. So of the total pipeline, it's only 150 meg. So it's of some which is quite so. But yes, we're going to go through that strategic partnership. We're going to co-develop 150 meg with them.
That's cool. Okay, and then we talk about this auction round stuff. I mean, just to clarify for people, so these happen every year, more or less. That these government subsidy auctions, and people bid to say what's the minimum level of price that they'd be happy with. So you've got stuff in all three of those. AR5 was sort of notoriously quite a low kind of clearing price, and AR6 has come out higher.
Yeah.
Does that mean you might not build some of this stuff, and you in preference to doing this stuff, or?
No, we would do it. In fact, the problem was in terms of, you're absolutely right, but the problem with AR5 was not to do with solar, it's to do with offshore wind. So it was offshore wind can get it to work economically because you, understandably, it's a riskier technology. You need a higher return. And they had a zero, I mean, basically no one bid into it because they couldn't get it to work because the offshore wind market is a very dynamic sector in terms of technology change. So, you know, I mean, people are seeing they're just getting bigger and you know, you actually got quite almost unproven technology in some ways. These are enormous, and then we know something the country should be very proud of. But we are, you know, people are pushing design and technology every time these turbines are going into the sea. So they're very, you know, so that anyway, they couldn't afford. Basically, costs have gone up partly post COVID. And the existing support mechanisms, because there's a sort of floor price, they couldn't get it to work. So the government for AR6 has materially increased both for solar and wind. So for us, in terms of the AR5 are very, very attractively priced. We have a different dynamic in solar. Solar is commoditized, and so we're still getting price reductions in the installation costs. So they all work very well because it's, as I say, we're not sort of using new technologies or having to kind of break new ground. It's something, so they all work very well, and they are very, very valuable for shareholders because again, those auctions are all closed now, and you can only bid in one time. So yeah, we're very pleased with that. And as I say, we've got over 400 meg of those assets now, which are have access to the CFD.
Cool, thank you. Now, the other thing it says here about the development pipeline is you've got battery projects in there. So maybe you could just flesh out slightly what you're saying about the battery subsidies possible, or you know, what might happen.
Yeah, well, it's quite live news. And so I'll caveat that I've read a press release this morning. So there's more to learn. So basically, the battery market and the listed space is fascinating, James, actually, because they are a really good example of cannibalization of pricing in action. So what's happened is that the generators like solar have long-term support mechanisms. So historically, it's been ROCs, it's now CFDs. So you have between 15 to 20-year support mechanisms. So that's the basis on which you can make economic returns. The battery market, until the announcement in the last 24 hours, didn't have any support. So what they were doing was that they were bidding in. So you could look at this with people like Grid and stuff. So they would bid in. They'd have a battery which would be a reserve power, and they'd try and bid into the grid to be a balancing mechanism. And the price it varied. And you'll see if you look at the track record, prices have been hugely volatile in terms, but you basically got day forward visibility, right? So now there's been problems with the battery market in terms of people bidding into it. So there's a whole story about how the grid is operating and all that sort of stuff. But if you just look at what's been happening with the battery market and the economics, is that batteries have been getting cheaper and cheaper and cheaper. So that's great for all of us as consumers because batteries are an incredibly important part of the story because they will balance the grid. But because solar and wind are intermittent. But the problem is that today's battery can outbid last week's battery, and suddenly you get this kind of sort of death rattle for all the old batteries. And so what happened was that they've just been really struggling, and just look at the share prices of any of the listed battery operators. Anyway, so we've been saying for a while the only way to do this, if you take the view which we do and the government does, is that batteries are absolutely essential for the net zero story to make any sense, and you have to have a lot of we're talking about billions of pounds worth of investment into batteries. You've got to, we've got to, James, we'll have conversations with people and we sit there in front of investors and they just nod and say, yes, I understand battery makes sense. And at the moment, then they're shaking their heads saying, I don't understand I can make any money out of this because there's cannibalization, I've got day forward visibility, blah, blah, blah. So what the government has announced, which I say very recently, last 24 hours, is that they are trying to create some sort of certainty in terms of pricing. So they've introduced a floor and a cap. So there's a range so that the operator knows that there is a de minimis amount of money that they can earn. And I presume it's going to be out for the whole duration of the battery. So that sounds to me like a very sensible, view. We were, I hope it's not too complicated. I mean, we were just saying they should just give them a fixed price because it's cheap. But nevertheless, it's a really bold statement because I didn't think it's been an interesting first 100 days for this government, but in terms of the energy policy, they are really pushing things through quickly. And so the announcement, as I say, has been made in the last 24 hours, and I think it's a very positive one. I should guess it will be very, very valuable. As I say, the detail is, the devil's in the detail, but I would guess if it's anything like it's been reported, it's going to be very valuable for the 500 meg that we have in this portfolio.
Cool. Take a step back slightly. Why are you just focusing on the UK? Why not go overseas? And why not look at sunnier countries, is the question here.
That's true. It's actually it's just on a risk-adjusted view we have. So we know that we have a European team within Bluefield Partners. So we have a team that's very, very experienced in investing. We've done it through private vehicles. When you're looking at sterling income, we have you need to have some fairly material premium above the returns you could make in the UK. We're making very good returns in the UK to justify it. And if you go to continental Europe, the returns in Northern Europe are far too low. You can't get the yield you need. So that's just a simple bit of economics. And then you can get the yield. Some of the other funds have gone to like Southern Europe. So Spain be a big one. But Spain is a merchant market and it's collapsed in the last 2 years. So it was like the best thing since sliced bread about 3 years ago. And now it's like literally it's on its knees. And that was our concern. It's like, where can we justify for our shareholders a risk-adjusted return that is comparable to what we can deliver in the UK? And bearing in mind, again, one of the reasons for this is that the return level we've delivered in the UK is very high because we've got this big focus on primary assets, and we know that market inside out. I'd say the only market there's no plan to do anything, but the market that looks most like the UK is the US. That's a great market. They've got long-term incentives. It's done through a rather complicated thing called a tax credit system. But that's a good market. That's probably the best one in terms of when you look at return, it's the geopolitical risk, big primary market. So that's one which we would look at. But that's the reason. So it's not really to do with the radiation, because for sure, in sort of Toledo, you can get more irradiation, but it's whether it's worth it because of the risk and the return you can get.
Oh, that makes sense. And then in terms of solar versus wind and whether there's anything else that would fit the mix, what was the attraction of the wind in the first place? And then would you look at other technologies?
Yeah, so we went for wind because it's the closest, apart from hydro is actually the closest to solar. If you want this predictability, actually hydro. The problem is you don't have enough scale in the UK, so you'd have to go to Europe for that. But yeah, so we just mentioned why we wouldn't go to Europe. So the nearest in terms of a risk return profile is onshore wind. We were very anti offshore wind when we did the change in 2020. We thought pricing had gone crazy. But basically in 2020 you were getting a lower return for offshore wind than you were for solar, that's an inversion of nature. You shouldn't be able to do that. It's a much, much riskier asset. So, but we like onshore wind, and we also like the slightly smaller. So I mentioned about these single stick turbine sites because they're ones where they're less bid up in terms of price because you don't have the very low cost of capital bidders like the Brookfields and UK Winds and Triggs and stuff. And then you've also got the ability to actively manage. So that slide I spoke about with 130 people. So what we're doing with our wind assets is we're actually, one of the big bits of focus is a repowering program, which is very accretive to shareholders. Again, it's active management, and that's where we think it's really attractive. Apart from the onshore wind side, the only area we're going to look at is batteries. So, and it's going to be, we do particularly like, and I'll sort of caveat this a bit because of the news in the last 24 hours, but We really like the co-located model. Storage and solar is a very, very good combination because solar is predictable, and so you know what it's going to do in the daytime pretty much, and it will load up batteries very consistently, and then you can discharge them. So it's a nice model, and it works very. It's a very accretive model because you're getting a share of the sort of infrastructure costs of the plant and the grid costs and all that sort of stuff. So that's something we will certainly look to push. And I think, as I say, the recent announcement is really encouraging for that strategy.
And then you mentioned the US market. One of the things that happens there is they have much longer PPAs, and also there seems to be increasing prevalence of building generation plant for specific off-takers for,
Yeah.
Is that something that might happen in the UK?
Yeah, I think it's going to have to, partly because of the grid constraints. I think people will need to be more creative in terms of how they are delivering those sorts of assets. What hasn't really developed very much in the UK has been this corporate PPA. So you've got two things. You've got either direct wire. So we've got a bunch of, they're very, very small, which James, from looking at the portfolio, but we've got some Thames Water assets. And we've got Toyota manufacturing. They're direct wire, so they're very close in proximity to where they say the plant is, and then you actually pump it straight in. That's a model that it's quite hard to sort of just scale because it's very kind of circumstantial in terms of whether you can do that, whether you've got enough ground to be able to do it, because solar farms take up quite a lot of space, or big ones do. So but I think we're going to look at, and we are looking, and I think others will start to look at how you can try and, are there other options in terms of getting close to where there are energy needs. And then one of the great things about solar is it's very modular and it can be put into different environments. It's very flexible. So the two areas I think that need development are, one is the commercial rooftop, or certainly that kind of is a market that we advised. I mean, we advised Amber Rudd on it, if you remember, when she was involved in it, so that would be about 10 years ago, and they just haven't moved it forward. There's quite a lot of complexity. So if you talk to the very big landlords of things like real estate in the UK, they were talking about businesses. I mean, the big, obviously the big sort of fund management houses in London, they have millions of square foot of rooftop, and they just haven't got any solar on it. So there needs to be something done there. There needs to be some sort of incentive to be able to create that, because it's quite complex for owners, because you typically don't occupy themselves. So there's a sort of something needs to be done there. And then I think also the corporate PPA market is one that there needs to be incentives, because every FTSE 100 chairman will say, I want to have 100% renewable energy, and then understandably, if it's more expensive than prevailing energy, the FD is going to go no. So you've got to work out a way of getting that. But the renewables are becoming the cheapest option. And so that, again, there can be sort of sleeving agreements where you'd be able to deliver that. So I think those two areas where you've got to think about how do you create capacity near users, and also the corporate PPA market, I think are two areas to really focus on.
Cool. And then in terms of the sort of dividend outlook, so it's obviously you've nudged the dividend target up.
Yeah,
the board has. I mean, I'm going to make it clear it's the board's decision, not yours. Do you think the dividend growth might be more modest, and you might use the cash flow for two other stuff going forward? Is that kind of thinking, or? No,
you're absolutely spot on. I mean, I think the dividend increase was from 8.8 pence to 8.9, so it's not, it's relatively slightly lower than inflation. The reason being is that the shareholders have made it very clear that they want capital allocation to include the repayment of the RCF and also the share buyback. We want to continue that as long as we're at a discount, or certainly a sort of meaningful discount. And I think also the other thing is, just to repeat, is it's a very high dividend anyway. It's the 8.9 pence per share, as I say, is only topped by UK Wind. Shareholders think it's a good dividend at that level anyway, so they're not really clamoring for us to increase it. There are peer group investors who are at sort of 6 pence, so it's a kind of it's materially higher than most. So I think that's the reason. And we in a normalized market where we're not doing share buybacks or paying down the revolver, then I think we'd expect to be a bit more ambitious with that. But as I say, it seems to work pretty well for where we are at the moment.
Oh, that's good. Thank you very much, James. We've covered an awful lot of ground, and I think hopefully people will understand the case business better. And so we'll follow up again in a year or so. I think we've got a note to come relatively soon. But thanks very much for doing this morning, and we'll talk to you again soon.
Thanks, James. Thanks, everyone.
Cool. And then we'll be back next week talking to Katie Potts from Herald. And then the week after, we've got Helen Sears from Pantheon International. So thank you very much indeed for tuning in today. I know some of the audience is off at the AIC showcase, so I'll be there later on. But thank you for your time, and have a good weekend, and I'll see you next week.